Hi, I am OG John AG. Today is February 27th, 2026, and I need you to stop whatever you are doing right now because the day that every single person in this channel has been circling on their calendar for the last 3 weeks has finally arrived. First notice day for March. COMEX silver is not coming anymore. It is here. It is right now. As I record this, the delivery clock has officially started ticking, and the numbers that are flashing across my screen are telling a story so extreme, so violent, so impossible to ignore, that I genuinely do not know how the mainstream financial media is going to explain this away. I have been tracking this market every single day. I told you about the 785,000-ounce daily drain. I told you that by the time China came back from Lunar New Year, registered inventory would be sitting somewhere between 93 and 96 million ounces. I told you that March open interest was sitting at a ratio of 4, 5, even 6 times the available physical metal. And today, on the single most important day in the silver market in the last decade, every single one of those warning signals has converged into one moment. The trap that was being set for weeks has just snapped shut, and the banks that are sitting on the wrong side of this trade are about to find out exactly how bad that feels. Let me walk you through exactly what the data is showing right now, what first notice day actually means in practice, why the next 48 to 72 hours are the most dangerous window in silver trading this year, and why China coming back from Lunar New Year 3 days ago is throwing gasoline on top of an already burning fire. Roughly 3 out of 4 of you watching right now are not subscribed. If this channel has been giving you the real numbers, the verified data, the unfiltered picture of what is actually happening in these markets while everyone else is still talking about charts and momentum, hit subscribe right now and turn on notifications. Because the next 72 hours are going to produce updates that you cannot afford to miss. If this is cutting through the noise and giving you clarity, drop OG John AG in the comments. That is how I know this community is locked in and ready. If it is not for you, no hard feelings. I am not here for vanity metrics. I am here for the people who want the truth. Now let me show you what is actually happening. First notice day on COMEX means that as of today, February 27th, any holder of a long March silver futures contract can formally notify the exchange that they intend to take physical delivery of 5,000 ounces per contract. They are not rolling forward. They are not cash settling. They are saying, give me the metal. And here is where this becomes the most important data point you have heard all month. COMEX registered silver inventory as of the close of business on February 26th sat at approximately 91.4 million ounces. Let me say that number again because I want it to land. 91.4 million ounces. In October of 2025, that number was 167.7 million ounces. We have drained 76.3 million ounces of registered silver from COMEX vaults in exactly 5 months. That is a 45.5% collapse in available registered inventory in 150 days. And today is the day that the market is going to tell us how many of those March contracts want to stand for actual physical delivery. Now, everyone watching this channel knows the historical baseline. Under normal conditions, somewhere between 2% and 5% of open interest stands for delivery. That is the average. That is what the textbooks tell you. That is what the banks were counting on when they built their short positions. But we are not living in normal conditions. We have not been living in normal conditions since the January 30th crash. February delivery rates came in at 98%, not 2%, not 5%. 98% of February open interest demanded physical metal. If March even comes in at half that rate, at 49%, we are looking at delivery demands that mathematically exceed the entire registered inventory by a factor that the COMEX system has never been designed to handle. March open interest as of last night sat at approximately 78,400 contracts. That represents 392 million ounces of theoretical delivery obligations. If 49% stand for delivery, that is 192 million ounces demanded. If registered inventory is 91 million ounces, the math does not work. There is no version of that equation that ends without either a forced cash settlement, a rule change, a declared force majeure, or a price explosion that makes the shorts run for the exit at any cost. All 4 of those outcomes are bullish for physical silver. 3 of them would be catastrophic for the paper market credibility that these banks have spent decades building. And here's the part that nobody is saying out loud. China came back 3 days ago. On February 24th, the Shanghai Gold Exchange and the Shanghai Stock Exchange reopened after 8 consecutive trading days of Chinese Lunar New Year closure. And when they came back buying. The Shanghai premium on silver as of this morning is sitting at $14 to $16 per ounce over Western spot. That means physical silver in China is trading at a 17% to 20% premium over whatever paper price COMEX is printing right now. After everything, after the January 30th crash, that was the worst single day in silver history, after the 31% drop, after the margin hikes, after the forced liquidations, after the Lunar New Year liquidity drain, after all of it, China came back and the premium is still double digits. That is not a market that believes silver is going lower. That is a market that is screaming physical shortage. And here is what makes the China reopening so explosive in the context of today. For the last 8 days, Western paper markets have been trading without the largest physical buyer on the planet. The price action we saw during the holiday window was paper fighting paper, futures against futures, with no physical backstop from Asian buyers to anchor reality. Now that backstop is back. Now the physical market is re-engaged on the Asian side at the exact same moment that COMEX first notice day is triggering on the Western side. You have Eastern physical demand pressure meeting Western delivery obligation pressure simultaneously on the single most important calendar date of the March contract cycle. That is not a coincidence. That is a convergence. And convergences in leveraged commodity markets do not resolve quietly. Let me give you the full picture of what the commitment of traders data showed heading into today. The latest COT report showed managed money net long positions in silver at 11,200 contracts. Compare that to the peak in January when net longs were above 85,000 contracts. We went from maximum euphoria to near maximum pessimism in speculative positioning in less than 30 days. The hedge funds, the momentum traders, the tourists who chased silver to $121 and got carried out on a stretcher during the January 30th crash, they are gone. They exited. They got margin called out. They swore off silver forever and went back to chasing Nvidia. The speculative crowd that created the euphoric top has been completely wiped out of the market. What that means is the positioning is clean. The leverage is out. The people who are still long silver going into today's first notice day are not tourists. They are not momentum chasers. They are not weak hands. They are the people who either hold physical in their own possession, or they are the institutional players who ran the models, looked at the deficit data, looked at the COMEX drain rate, looked at the Shanghai premiums, looked at China's export restrictions, and made a calculated decision that they want delivery. They want actual metal. And now they are exercising that right. Let me talk about what JP Morgan's positioning tells us going into today, because this is the smoking gun that you are not going to hear about anywhere else. In the previous videos, I documented that JP Morgan closed 6.33 silver short contracts at the exact bottom of the January 30th crash. Not near the bottom, at the bottom. That told us everything about their intent. They created the bottom, they timed the liquidation, and then they covered their shorts at the lowest possible price. Now here's the question you need to be asking. After covering those shorts, after going through the entire Lunar New Year period, after watching registered inventory drain from 103 million ounces at the time of the Lunar New Year warning down to 91 million ounces today, after watching China come back at a 17% premium, what side of the trade is JP Morgan on right now? Because here's what the data suggests. JP Morgan has historically been the issuer of the majority of COMEX silver delivery notices. In January, they issued 99% of all delivery notices for that month. One bank, 99%. If they repeat that pattern in March, and the delivery demand is larger than anything the system has seen at these inventory levels, then JP Morgan is going to be in the position of sourcing physical silver in a market where registered inventory is 91 million ounces, and delivery demand could be 100 million, 150 million, or 200 million ounces. You cannot source silver that does not exist in registered vaults. You cannot issue a delivery notice for metal that nobody is willing to deliver, and you cannot pay the price premium that China is currently willing to pay if you are committed to holding the paper price down. Something has to give. The unresolved tension in this market right now is the most extreme it has been in at least a generation, and today is the day that tension begins to find its resolution. Now let me address the Bitcoin signal because I have been telling you to watch Bitcoin as a leading indicator for silver, and right now that signal is giving me a very specific read. Bitcoin is currently trading around $83,400. It has recovered from the $65,000 danger zone that I flagged multiple times as the line in the sand. When Bitcoin broke back above $75,000, I said that was the all-clear signal for risk assets. Bitcoin is now pushing against the $85,000 resistance zone. If Bitcoin clears $85,000 and holds above it with volume, that removes one of the major headwinds for silver. Because a strong Bitcoin means institutional risk appetite is recovering, means the flight from dollar assets into alternative stores of value is broadening, means the same macro forces that are pushing gold above $5,000 are now pulling silver back into the spotlight. The gold to silver ratio right now is sitting at approximately 62 to 1. At the January peak, that ratio was 30 to 1. Every 10-point compression in the gold to silver ratio from current levels with gold at $5,000 implies a $16 to $17 move higher in silver. If we go from 62 back to 50, silver trades at $100. If we go from 62 back to 40, silver trades at $125. If we go back to 30, where we were in January, silver is at $167 with gold held constant. I am not calling a price target. I am showing you the mathematical relationship. And the fact that the ratio is at 62 when the physical silver shortage is more severe today than it was in January when the ratio was 30, that is not a market operating on logic. That is a market that just went through the most violent speculative washout in its history and is now resetting. The physical reality has not changed. Only the speculative positioning changed, and positioning can change back a lot faster than inventory can be replenished. Let me now walk you through the 3 scenarios for how today and the next 48 to 72 hours could play out, because one of these scenarios is going to determine the trajectory for March, April, and potentially the rest of 2026. The first scenario is an orderly delivery process. This is the base case, and I put the probability at 35%. In this scenario, COMEX manages the delivery notices that come in today by sourcing metal from the eligible category, negotiating with holders, issuing notices through JP Morgan and other clearing members, and generally keeping the system running without public drama. Delivery demand comes in at 20% to 30% of open interest, somewhere between 78 and 118 million ounces. COMEX delivers it. Registered inventory drops another 20 to 30 million ounces, and we end the month at 60 to 70 million ounces registered. That still sets up an even more critical April delivery month. In this scenario, silver stays in the $80 to $90 range. The squeeze narrative gets pushed out to April or May. Weak hands breathe a sigh of relief. The mainstream financial press declares the silver crisis was overblown. And then the April delivery month arrives with even less registered inventory and even higher delivery demand. The can gets kicked, but not very far down the road. The second scenario is a partial squeeze. Probability 40%. This is where delivery demand comes in between 30% and 60% of open interest, somewhere between 118 and 235 million ounces. COMEX has 91 million ounces. They cannot fill all those requests from registered stock. They begin converting eligible metal to registered, which requires the consent of the vault holders. Some holders refuse. Others demand a premium. The spread between spot and futures explodes. Silver goes into severe backwardation. The price starts moving up sharply as the shorts race to cover rather than deliver metal they cannot source. In this scenario, silver breaks $85 within 24 hours, breaks $90 within 48 hours, and potentially tests $100 by end of next week depending on how fast the short covering cascade moves. Gold follows silver higher. GDX and SAIL mining ETFs explode 15% to 25% within days. Physical premiums at coin dealers, already running at 30% to 100% over spot on Eagles, go parabolic. The U.S. Mint suspends new sales again. Delivery times at major dealers go back to 8 to 12 weeks. APMEX and SD Bullion report sold-out conditions on most popular products. This is the scenario that turns this channel from an analysis resource into a historical document. Because if the partial squeeze hits today, the screenshots, the data, the warnings, every video in this library becomes evidence of what the market looked like before the system broke down. The third scenario is the force majeure or rule change, probability 25%. This is the most extreme outcome, and I am not going to pretend it is impossible because the data does not allow me to pretend that. If delivery demand comes in above 50% and COMEX cannot source the metal, they have 3 options. Cash settlement at the current paper price, which means long holders who wanted physical get paid in dollars instead. A declared force majeure, which is effectively a default on physical delivery obligations. Or an emergency rule change that limits delivery, raises margins to the moon, and functionally transforms the March contract into a cash-settled instrument. All 3 of those outcomes would be the single largest admission in COMEX history that the paper-to-physical ratio has become completely divorced from reality. All 3 would trigger a flight to physical metal so extreme that premiums would go to levels nobody has ever seen. All three would validate every single thing that the people in this channel have been saying for years about the difference between paper silver and real silver. And all three would be immediately followed by the mainstream financial media calling it unexpected, calling it unprecedented, calling it a technical anomaly, while the people watching this right now would already be positioned because we have been tracking this for months. Now let me give you the real framework for how to think about today if you are a physical holder versus if you are a futures trader versus if you have not yet made a move and are watching from the sidelines. If you hold physical silver, today is the day you have been waiting for. You do not need to do anything. You do not need to buy more. You do not need to sell. You just need to understand that the system you have been watching strain under the weight of its own contradictions is now being tested in real time. And the physical metal in your possession is the ultimate expression of the thesis you have held. Every ounce you own is outside the paper system. It cannot be margin called. It cannot be cash settled against your will. It cannot be subject to COMEX rule changes. It exists outside the game that is being played right now, and that puts you in the strongest possible position regardless of which of the three scenarios unfolds. If you are a futures trader with March contracts, today requires absolute precision. The delivery window creates opportunities but also traps. If you are long and want delivery, you need to have your ducks in a row with your broker right now, not tomorrow. Now. Make sure your account is flagged for physical delivery. Make sure you understand the delivery costs, the vault locations, the timing. If you are short March futures, I would strongly suggest you are not sleeping well tonight, because the delivery demand that is being registered today is going to tell you very quickly whether the shorts have a manageable problem or an existential one. If you are on the sidelines and you have been watching this unfold and wondering whether the boat has left the harbor, here's the honest answer. The fundamentals of the physical market are more bullish today than they were in January when silver was at $121. Supply is tighter. Inventory is lower. China's export restrictions are still in place. The industrial deficit is still in its sixth consecutive year. None of that changed. What changed was the speculative positioning, and that is the thing that has now been completely reset. The speculative tourists are gone. The weak hands are out. The leverage has been cleared. What is left is the structural demand from industrial users, central banks, sovereign wealth funds, and the kind of long-term holders who use first notice day to take delivery. That is a cleaner, stronger foundation for the next move than anything we had in January when everyone was euphoric. Here is one more data point I want to leave you with because it ties everything together. The Silver Institute, the most authoritative voice on global silver supply and demand, confirmed on February 10th that 2026 will be the sixth consecutive year of a global silver supply deficit. Physical investment demand is forecast to rise 20% to 227 million ounces, a three-year high. Industrial fabrication is running near all-time records from solar panels, electric vehicles, AI data centers, and defense applications. Mine supply cannot keep pace because 70% to 80% of silver is a byproduct of copper, zinc, and lead mining. You cannot flip a switch and produce more silver. The mines respond to copper prices. They respond to zinc prices. They do not respond to silver prices with any meaningful speed. The structural deficit is built into the system for years to come. And today, on first notice day, with 91 million ounces of registered inventory against 392 million ounces of potential delivery demand, with China back in the market at a 17% premium, with JP Morgan's positioning showing they covered their shorts at the January bottom, with Bitcoin recovering above $83,000, removing the risk-off headwind, with the gold-to-silver ratio at 62-1 against a physical shortage backdrop, with industrial demand running at record pace, the setup is as clean as it has ever been. I said from the beginning that the biggest buying opportunities in silver always come after the most violent sell-offs. January 30th was the most violent sell-off in silver's recorded history. And now, 28 days later, on the day the system gets its most important stress test, the physical market is still holding a 17% premium over Western paper prices. The physical market is not confused about what silver is worth. The physical market never was. Do your own due diligence. Understand the risks. Today is not a day for leverage. Today is not a day for hero trades. Today is a day for watching the data, watching the delivery notices as they are filed, watching the registered inventory update tonight at 9:30 p.m. Eastern on the CME website, and understanding that whatever the next number shows, it will tell us more about the true state of this market than anything the mainstream financial press has said in the last 3 years. I will be monitoring every update as it comes in today and through the weekend. If you want those updates as they happen, you are subscribed. You have notifications on. If you do not, you might catch the analysis after the fact, but that is not the same thing as being here when it matters. The system is being tested right now. Today, February 27th, 2026. First notice day, the trap is set, the clock is running. And the next 72 hours will tell us whether the paper market can hold the lie together for one more month, or whether today is the day that physical reality finally wins. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. OG out.